The Fed's final stand, criminal probes, tariff traps, and the battle for the U.S. economy. Hello, everyone, and welcome back to Economics Without Myths. We are currently witnessing one of the most volatile intersections of politics and high finance in American history. Today is January 29, 2026, and the fallout from yesterday's Federal Reserve meeting is sending shockwaves through Wall Street and Washington alike. In this episode, we aren't just looking at interest rates. We are analyzing a constitutional crisis in the making. For the first time, a sitting Fed chair is facing a criminal investigation from the Department of Justice while simultaneously trying to prevent an inflationary spiral triggered by aggressive new trade tariffs. Before we dive into the deep end, I want to thank our growing community. Your engagement is the fuel for this independent analysis. If you value economic clarity in an age of political noise, please hit that subscribe button, like this video, and share your thoughts in the comments. Your support helps us bypass the algorithms and keep these deep dives coming. Today, we unravel three critical threads: the Fed's strategic pause at 3.5% and the secret data driving it. The unprecedented legal war against Jerome Powell. Is this the end of central bank independence? The tariff trap in U.S. manufacturing. Why your local factory might be winning on paper but losing in reality. Let's get started. Segment 1. The Federal Reserve's steady hand amid a storm. Yesterday, Jerome Powell and the FOMC made a decision that many call a defiant pause. They held the benchmark federal funds rate steady in the 3.50% to 3.75% range. But to understand why this matters, we have to look at the context of 2025. Last year, the Fed cut rates 3 times. Markets expected the easing to continue, but the Fed just hit the brakes. Why? The primary driver is a new form of sticky inflation. While consumer demand is stabilizing, supply-side costs are surging. The Fed's mandate is a dual one: maximum employment and price stability. However, they are currently seeing a labor market that is softening under the surface. December saw only 50,000 jobs added, well below expectations, yet unemployment remains low at 4.4%. The Fed is caught in a data dependency trap. If they cut rates to save the weakening job market, they risk fueling the inflation caused by new 25% tariffs on imported goods. If they keep rates high, they might trigger a recession. Powell's message was clear: the policy stance is appropriate for now. He is waiting to see if the inflation we're seeing is a temporary tariff shock or a permanent structural shift. Segment 2. The Political Storm, the Criminalization of Monetary Policy. This is where the story turns from economics to a political thriller. As Powell stood at the podium yesterday, he wasn't just defending a 3.5% interest rate. He was defending his freedom. The Department of Justice has opened an investigation into Powell, and Governor Lisa Cook, citing a construction project at the Fed's headquarters, but Powell didn't hold back in his response. He explicitly described these moves as retaliatory actions and intimidation from the White House. President Trump has been relentless, claiming the Fed's refusal to cut rates is costing the U.S. hundreds of billions of dollars. Why does central bank independence matter to you? It's the wall between your savings and political desperation. Politicians operate on 4-year election cycles. Their incentive is always cheap money now, inflation later. The Fed's job is to be the adult in the room who takes the punch bowl away just as the party gets going. If the White House successfully weaponizes the DOJ to force rate cuts, the U.S. dollar risks losing its status as the world's reserve currency. We are watching the most significant test of the Fed's 113-year history. Segment 3. The Tariff Trap, Winners, Losers, and the Manufacturing Mirage. While the Fed fights the White House on rates, the administration is doubling down on protectionism. But America First is proving to be a complex reality for U.S. factories. We are seeing a divide between finished good winners and component losers. Tariffs are designed to protect domestic industries. For a company making a 100% U.S.-sourced product, a 25% tariff on foreign competitors is a gift. But the modern U.S. factory doesn't work that way. Most American-made products rely on a global nervous system of parts. Current data shows that tariffs are hitting the raw materials steel, aluminum, and specialized semiconductors that U.S. factories need to build their products. This is the tariff trap. A factory in Ohio might be happy that foreign finished goods are more expensive, but they are simultaneously seeing their own production costs rise by 15 to 20% because the parts they import are now taxed. This is cost-push inflation, and it's the Fed's worst nightmare because interest rate hikes can't fix it. Segment 4. Case Study, The Loloi Effect and the Inventory Cliff. Let's look at a real-world example. Loloi, the famous rug manufacturer. Their story is a blueprint for what's happening across the retail sector. When the 2025 tariff threats began, Loloi didn't stop importing. They stockpiled. They filled warehouses with inventory from India and Turkey to beat the tariff deadlines. For a year, it looked like they won. They kept prices stable while their competitors struggled. But now, in early 2026, we've reached the inventory cliff. Those stockpiles are empty. Loloi and thousands of businesses like them now have to restock at the new 25% tariff rates. This means the real inflation from 2025's trade policies is only just hitting the shelves now in 2026. This lag in data is why the Fed is so hesitant to cut rates. They know the inventory cliff is about to send a new wave of price increases through the economy. Segment 5. The Feedback Loop. When fiscal and monetary policy clash, we are witnessing a dangerous policy tug-of-war. The White House is using fiscal policy, tariffs, and tax cuts to stimulate domestic growth, which is inherently inflationary. The Fed is using monetary policy high rates to cool that same inflation. It's like a driver hitting the gas and the brakes at the same time. The result isn't a stable car, it's a burnt-out engine. If the Fed yields to political pressure and cuts rates now, they will pour gasoline on the tariff-driven inflation fire. If they stay firm, the high cost of borrowing combined with high tariff costs could crush small and medium-sized manufacturers who don't have the cash reserves to survive. Segment 6. The 2026 Prognosis, a neutral level or a breaking point. As we look toward the rest of 2026, the big question is, where is the neutral rate? Powell believes 3.5% is neutral, meaning it neither stimulates nor restricts the economy. But in an era of trade wars, neutral is a moving target. Powell's term as chair ends this May. The president is already interviewing successors who are expected to be much more dovish, meaning they will likely cut rates regardless of inflation data. If Powell is replaced by a political appointee, expect a short-term stock market rally followed by a long-term decline in the dollar's purchasing power. Final summary. Let's wrap up. Firstly, the Fed is on a strategic pause because they see a softening labor market but can't ignore tariff-driven inflation. Secondly, Jerome Powell is fighting for his professional and legal life, making the Fed's independence the most watched story in the financial world. Thirdly, the inventory cliff is here. The stockpiled goods are gone, and the true cost of trade wars is about to hit your wallet. Thank you for joining me on Economics Without Myths. This is a developing story, and I will be here to break down every update as the May transition approaches. If you found this deep dive helpful, please share it. The more people understand these mechanics, the less we are susceptible to the myths. I'm Bodden, and I'll see you in the next episode.